If I were to tell you that, merely by observing a single candlestick, I could already predict that the price was going to rise, would you find that believable? Indeed, I managed to secure a 10% profit from that particular trade. Now, you might be curious about how I was able to foresee the price increase. The secret lies in the candlesticks. Allow me to share with you my preferred candlestick patterns that I utilize on a daily basis. If you also become proficient in all these candlestick patterns, nothing will be able to prevent you from achieving profitability. Don't miss the second and sixth candlestick patterns, as these two appear in daily trading. If you fail to spot them, the market will ascend significantly and you'll find yourself waiting for an opportunity to enter. The bullish engulfing pattern is a reversal candlestick formation that signifies buyers have made their presence known in the market. At this point, the downward trend may cease, and an upward trend could commence. Within this pattern, a diminutive red candle is succeeded by a substantial green candle that entirely engulfs the preceding red candle. It's akin to a large predator consuming a smaller prey. Should this pattern emerge near a significant zone, its potency is amplified. It communicates to traders that the market control is now in the hands of the buyers, but in a bearish engulfing pattern, the opposite happens. This pattern indicates that the uptrend is about to end and a downtrend may begin. In this pattern, first, a small green candle forms, followed by a large red candle that completely covers the previous green candle. If this pattern forms near a resistance or supply zone, it is considered an even stronger signal that sellers have become active. However, remember not to rely solely on one candle in trading. You cannot plan based on just one candle. Whether it's bullish engulfing or bearish, use both patterns in combination with support, resistance, or indicators to get real results. I would recommend using the RSI indicator, which will help you find the right support and resistance. If the price is in the oversold zone and you see a bullish engulfing pattern at support, you can plan a trade. If a bearish engulfing pattern forms at resistance and the RSI is in the overbought zone, then you should plan a trade. Remember, in both patterns, it's important for the angle of the previous candle's body to be considered, not the wick. For more confirmation, use these patterns in conjunction with volume support, resistance, or trend. My favorite candlestick pattern, which I use in a sideways market, is the momentum candlestick pattern. Let's first understand the definition of the momentum candlestick pattern and how we can identify it. A momentum candlestick is a large candle, 2 to 3 times bigger than the previous candle. The size and direction of this candle indicate that a one-sided strength has come into the market. Now, the market can show a significant momentum in the direction of the candle. This candle often appears after a sideways or range-bound market. And this indicates that smart money or big players have taken control and the price will move in the same direction, the direction in which the momentum candle has formed. Easy points to identify a momentum candlestick. The body size of the candlestick is considerably large. The color of the candlestick is distinct. If the momentum candlestick is green, it indicates that the buyers are significantly strong. And if the momentum candlestick is red, it signifies that the sellers are very strong. The candlesticks preceding the momentum candlestick are typically small. This candlestick often forms during a breakout or a breakdown. Now, the question arises, how to utilize the momentum candlestick in trading? I employ the momentum candlestick in a sideways market by observing liquidity, and if a large green candlestick forms, it indicates a bullish momentum, which might present an opportunity to buy. Similarly, if a large red candle forms, it indicates bearish momentum, suggesting a plan to only sell trades. Often, this candle also signifies the beginning of a new trend. This particular pattern can be observed exclusively at support and resistance levels when 2 or more consecutive candlesticks form at a support or resistance level, with wicks consistently pointing in the same direction. Specifically, all the candlesticks' tails or shadows appear upward at resistance or downward at support. This pattern signifies that the price is persistently pausing at that level, but it is unable to break. This means there is repeated rejection in the market, indicating that smart money or big players are present at that level, controlling the price. As a result, multiple doji candles are forming. Now, how to analyze the multiple weak candlestick pattern? If wicks are forming downward at the support, it means buyers are strong and are preventing the price from going below the support, increasing the likelihood of the price moving upwards. And if wicks are forming upwards at the resistance level, it means sellers are active and there is a possibility of the price falling. Friends, what is the advantage of this pattern? This pattern provides us with information about the strength zones in the market where buyers or sellers are holding the price, which acts as a confirmation signal for us before taking an entry. So, how will you create a strategy for this pattern? Let's find out. First, you need to identify the levels. Recognize a strong support or resistance on the chart. where the price is consistently halting, verify if there are 2 or more candlesticks at that particular level with wicks pointing in the same direction. For making an entry, you should observe that after several weak candlesticks at support, if a bullish candle closes in the direction in which the price intends to move, then it serves as a signal for entry. This particular pattern emerges when there is a state of indecision between the buyers and sellers within the market, and no definitive direction can be ascertained. The doji is a distinctive type of pattern. How exactly does it come into existence? When a candlestick commences at a specific point and concludes at the identical point, its body appears exceedingly slender or nearly imperceptible, with elongated wicks extending both above and below. The doji candlestick pattern is regarded as a potential signal for trend reversal in trading. How does this occur? When the market is persistently ascending and then unexpectedly a doji candle materializes. This means the buyers are exhausted and there is a possibility that sellers are now becoming active in the market. This could be a bearish reversal. If you see a doji after the trend and its next candle is strong and rising, it could be a great opportunity for a silent entry. In a downtrend, the opposite would be true. If you see a doji form after a downtrend and then its next candle is a strong green candle, you might consider going for a buy. However, you must use candle confirmation, support resistance, RSI, or any other indicator along with the doji candlestick pattern. You will find several variants of the doji candlestick pattern, such as certainly, long-legged doji, dragonfly doji, and gravestone doji are significant patterns. Therefore, whenever you engage in trading with any of these doji patterns, it is crucial to always trade with 1 or 2 confirmations. The hammer candlestick pattern is the sole pattern that is regarded as quite accurate, frequently observed following a downtrend at a robust support or demand zone. Its body is relatively small and there is a long wick beneath the body. This pattern signifies that buyers elevated the price at the last moment. Now, how will you formulate a strategy for the hammer pattern? Initially, you must identify the appropriate zone. The hammer candlestick pattern should consistently form near a robust support order block or a fair value gap. Subsequently, for confirmation, it is essential to observe a strong bullish candle following the hammer candle. In a similar manner, the shooting star pattern emerges after an uptrend. Numerous individuals also refer to it as an inverted hammer. You can observe this particular pattern at a resistance or supply zone. Its body is oriented downward with an elongated wick above. This signifies that the seller drove the price downward at the final moment. In the strategy for this particular pattern, it is necessary to identify a robust supply zone or resistance level. The formation of a bearish candle subsequent to the shooting star serves as a confirmation. I would suggest utilizing the RSI indicator because it indicates when the price is excessively overbought or oversold, which can assist you in analyzing this pattern. Friends, now comes my personal favorite, the tweezer top and tweezer bottom pattern. The tweezer top is composed of 2 candles, with the first being a strong green candle. It forms at a distance and then its next candle forms a ride which starts from the high of the previous green candle. Both will have the same high, provided there should be no wick above both candles. In the tweezer's bottom pattern, it will be the opposite. This pattern forms after a downtrend. The first red candle forms at a strong support. After this red candle, a green candle will form. Both will have the same low. There should be no wick below both candles.